All right, welcome back. Number of developments. We're back, okay?
Okay.
Number of developments I want to bring to your attention. We have seen the stock market slide to near the lows of the day within the last 10 to 15 minutes or so. May have something to do with what you're looking at on the screen. A tweet from the editor-in-chief in China of the Global Times there, who tweets the following. You're looking at it. China on Tuesday issued 20 directives to boost consumption in an effort to further tap the domestic market, not putting so much emphasis on the trade talks. China's economy increasingly driven internally, more and more difficult for the U.S. to press China to make concessions. Maybe the market didn't like the way that sounded. If you think that China wants to make a deal, like the president said yesterday at the G7, so that perhaps caused stocks to slide a bit. The Dow is down 123. S&P's down about 11. That's 1/3 of 1%. We're also getting a response now from the Federal Reserve to Bill Dudley's op-ed today that suggests that the Fed shouldn't, in his words, enable Donald Trump on the trade war. Here's what the Fed says. Quote, the Federal Reserve's policy decisions are guided solely by its congressional mandate to maintain price stability and maximum employment. Political considerations play absolutely no role. That coming from the Fed moments ago, reacting to Dudley. Also moments ago, a little more than 10 minutes ago, the president tweeting once again about the Fed. The Federal Reserve loves watching our manufacturers struggle with their exports to the benefit of the other parts of the world, says the president. Has anyone looked at what almost all other countries are doing to take advantage of the good old USA? Our Fed has been calling it wrong for too long. So that continues, the fight between the president and the Fed. Now you have Dudley, the former New York Fed president, saying what the Fed shouldn't do as a result of the trade war. And you've got this allegedly independent Fed embroiled in this political potato big time. I want to bring in Richard Fisher into this conversation with us as well. Rick, he's the former president of the Dallas Fed. He joins us by phone. Mr. Fisher, it's good to have you back. What do you think of what Mr. Dudley says? The Fed shouldn't enable Donald Trump.
Well, I agree with that. First of all, if you look at what's happened to the manufacturing sector, all the uncertainty there derives from Trump policy. And the concerns about supply chains and where you locate your production facilities and so on have nothing to do with Federal Reserve policy. And if they were to cut by 50 basis points, which I do not believe they will, it wouldn't have any effect whatsoever on that uncertainty. So why would you spend a quarter point or 50 basis points when you don't have to, particularly given that consumption is still running very strong? So one of you mentioned earlier that consumer confidence peaks just before recession. Of course that's the case, because over 70% of our economy is driven by consumption. 11% is driven by manufacturing. I don't think the Fed should move. I don't think they should do anything at all in September. If they do 50 basis points, as was just suggested, I think it'd scare the hell out of the market. It would indicate that we're really deeply worried about the economy.
Dudley makes these arguments, but don't you feel like he undermines his own argument of independence? He takes a political bent off whether he likes the policy or not. He says it clearly. I mean, policy always has had outcomes in the political arena. It's not the Fed's job to decide whether they agree with the policy or not.
No, I think the Fed should keep on the course they've been on, which is not comment, except for to discuss the uncertainties created by trade. I would probably argue that you take one step further than the current posture, which is to point out again that the supply chain concerns and the other things, the vexing issues that are affecting manufacturing, are not related to monetary policy, but are related to trade and other policies, and say nothing more.
You think Dudley?
I think it's very important. I think it's very important not to move in September. I mean, look at where the 10-year is today, under 150, and it's no. If you look across the yield curve, we are almost back to the all-time lows that came right after Brexit, the week after Brexit, when the 10-year Treasury was at 136.6. We're within shouting distance of that. Rates have come down across the yield curve. I can't think of a single business in America, whether it's on the NFIB database or reports or in large corporate America, where people are complaining about the cost of money or availability of capital. It just doesn't exist right now.
You've made
so
that
why would you further the myth that the Fed's actions are determining the shape of the yield curve?
No, you've made that argument on this program before, and many people agree with you that there's no issue with the cost of money, access to capital,
right,
et cetera. Then Rick Reeder, who's still with us, Mr. Fisher, why, Rick, then should they cut 50 basis points?
Good question.
For me,
why, Rick?
It's for Rick Reeder.
Yep, so I'll throw that out there. So first of all, I think you have to operate in a global economy. I think what we saw last year is when you do raise rates and you keep going through that program, you end up shooting the dollar higher. You'd have the same dynamic today. As I said, 20 central banks are cutting rates. The other dynamic that is really important is this asymmetric concept of if you create a deflationary dynamic in the system today that is imported, quite frankly, from the rest of the world, it is extremely dangerous. To move the equilibrium rate of interest down to a level, and by the way, my point about going 50 is incrementalism. When you move 25, particularly as you approach the zero bound, doesn't have any real effect. If you go 50 and then say, that's what we needed to do, and we're going to leave it there, that's when you can create an impact. And by the way, I would argue at the equity market, there are a couple of things the equity market pivots off of. Obviously earnings, but it also pivots off of equity risk premium and where the risk-free rate is. And if the risk-free rate does come down, it does tend to buoy the equity market over time. And you see that over periods of time. So anyway, I disagree that I think the equity market would react violently to the negative to a significant rate cut. But I want to hold to this point. There's an asymmetric dynamic when you're at, particularly when you're close to the zero bound, and particularly when you operate in the global economy that we do today.
Right. So Richard, how do you respond to that?
No, I have a high regard for Rick, and I think his points should be considered. I do think what is driving the dollar and what is driving rates is our relative attractiveness in this global economy. So if you remember, at the beginning of the year, the 10-year was trading around a little above 250. So we're down 100 basis points. The euro-dollar rate was above 115. We're at 110.90 or where we are this morning. Those two things are intimately linked because we have a negative interest rate regime elsewhere, particularly in Europe, and we're very attractive, relatively speaking. Is this a negative for the U.S. economy? No. It's a negative for the S&P 500. But for the average job-creating American company and for consumption, it's a plus. And indeed, it offsets the whole tariff issue for the consumer. We have a stronger purchasing power. The Fed does not work for the markets. And I think this is one of the great concerns and conceits of traders. The Fed is geared towards the real economy. The real economy is driven by consumption. And a stronger dollar is good for consumption, not bad for consumption. So this is you have to remember the mentality of the FOMC members, of which I was one, and the way you have to look at the economy is not driven by the equity markets or the S&P 500. And I agree with Rick that not moving would, given the expectations, or even moving 25 basis points, given that their expectations for more, might have a negative reaction in the market. So I think he's correct on that. But you should gear it policy to? I don't believe so.
You suggested at the top, though, that you agree with a lot of what Dudley said, even though he's suggesting that the Fed, even if the policy out of the White House is harmful to the economy, that it shouldn't react to clean it up because he believes the policy is misguided. That's not for him to say, is it?
No, and that's why I said the Fed shouldn't comment on this, except for to point out, as whatever the action they take in September, 25 basis points, 0, 50, whatever it is, and we don't know, that their actions cannot mitigate the uncertainties created by trade frictions. And they've come close to saying that. I would just articulate a little more thoroughly. And that's it, not say anything more. Jay Powell and the FOMC, this is what they signed up for. Maybe not the barrage of criticism and that they've received from the President of the United States. But they know the history. We went through this with Arthur Burns. We went through it with Paul Volcker. We've gone through it with other Fed chairs. This is just more extreme. But this is what they signed up for. And by the way, one last thing. The miracle of the FOMC is that the bank presidents are not subject to presidential appointment and senatorial approval and confirmation. Eric Rosengren, ever since I first came in with him a jillion years ago at the Fed, has always been a thought leader. And what he's saying, I would pay particular attention to. Esther in Kansas City follows the tradition of Tom Honig. Very outspoken, but always hewing to the real economy. So I would listen carefully to these people. You've got at least 3 now that have said they wouldn't support any further action. We'll have to see what the data unfolds between now and the September meeting. But my point is this. This is not unique. There's a long history. There's also a long history of the Fed folding its cards, as they did under Arthur Burns, the least respected of all former Fed chairs. And in the portrait gallery outside the FOMC room of all the former Fed chairs, if you were to put a big black X in black tape over a portrait of you over Arthur Burns, who prostituted himself to a president. So, I think you have to understand the dynamic, the history of the Fed. You have to understand what they gear their policy to. And I think Dudley goes a little bit too far, although he's always been a good friend and was a great leader of the New York Fed. I would just say very little more, but point out what the Fed gears itself to and its limits of power, which has already come out from the Jackson Hole Conference.
Right. Richard, we appreciate the time. I think you're on vacation, so we appreciate you taking that time.
I even appreciate Rick Reeder.
It's nice to have both of you in this conversation. Op-ed that's getting a lot of conversation around desks today. That's Richard Fisher.
Bye.
Rick Reeder, you want to give me your last point on that topic? Because it's the topic du jour of what the Fed's going to do and what the Fed should do, and then ultimately what the market decides to do as a result.
Listen, I think Dudley's a very smart guy, and I think he makes some very good points. Listen, I think the Fed, and one thing I'm certain of, Jay Powell and the Federal Reserve are going to do what they think is right for the economy at that point in time, and I think some of the assertion that they are being driven by the president, and I hear a lot of that when I travel globally, I just don't buy it. I think they're going to make the decisions that the economy warrants a certain amount of accommodation, and they're going to make the decision based on it. And I think that is just what they should do.
But consider
when you
influence
trade.
Consider the other side of that, though, and it goes to the part of the point that Dudley's making. They may not be driven to cut rates because of the president, but Dudley almost suggests that they should be driven not to cut rates by virtue of what the president's doing. You follow me?
Right. Yeah, I do. Listen, I think at the end of the day, a lot of those, it's hard to separate the action from the reaction. There's a confidence dynamic. There's a CapEx confidence dynamic that takes place, and there's a real trade. You talked about it earlier in the show. If trade slows, which it is, and if export slows, and if manufacturing slows, then the Fed has to be responsive to that. And I think that's what, at the end of the day, that's what they're going to do. And I am convinced that they are not politicized and will make the right call in terms of doing that, which I think today the economy can take a bit more accommodation to get to an equilibrium rate of interest that's lower than we are today. And by the way, when people say the 10-year part of the curve, the 10-year moves based on market conditions. The front end moves by the Fed, and the front end could take a little bit more in terms of accommodation today.
And maybe it'll just get that. Rick, we appreciate it. Good last point to make there. We'll talk to you again soon. That's BlackRock's Rick Reeder. Here's what else is coming.